Good morning, good afternoon, or good evening. I hope you guys are doing well. So, today we are going to start with the next important chapter, that is corporations. Okay, so in corporation, like first we are going to see that which businesses will be taxed as a corporation, how the property exchanged for a stock in the corporation will take place, what are the filing and paying income tax penalties and other special provisions, some special deductions, figuring the taxes, shareholders ENP, right, earnings and profit, Form 1120, 1120S, and 1065 Schedule L, M1, M2, and M3. Then we'll see that distributions, how the distributions will take place, redemption of stock, and then at the last, S corporation. Okay, so let's start with the first topic, that is business taxed as a corporation. How the business, will be taxed as a corporation. First, we need to know who all are going to be covered as the corporations. In partnership also, we saw that there was a list of companies or corporations who were not allowed to be participated in a partnership firm, right? Who cannot create a partnership firm. So these are the list which can be treated as a corporation. So business who is formed under the federal or state law, corporation, body corporate, body politics, joint stock company, joint stock association, insurance company, certain banks, business who are wholly owned by the government, local government, certain foreign businesses, and business who elects to be taxed as a corporation by filing form 8832. In if it's a LLC, right, they can elect to be treated themselves either as a S corp, C corp, or as a partnership. So if they file the form 8832 and elect themselves to treat as a corporation, they will be covered under this chapter and this tax law. I can say 1120. Okay. So next is personal service corporation. So there are some types of corporation. We'll see there are three types of corporation. First is personal service corporation. Personal service corporation are the corporation who are liable for a flat tax rate, that is directly 21%. Okay. Principal activity in the prior year of those corporation, personal service corporation, is performing the personal services, right? Plus the employees. The persons who are performing the services are the owners who substantially perform the services. The employees are only the owners, and that is how we will call that type of corporation as a personal service corporation. Okay. Now, the employee should own more than 10% of FMV. Remember the word FMV, of outstanding stock, on the last day of the prior tax year. Okay, more than 10% of the FMV of the stock on the last day of the prior tax year. So two things the owner will do. First, they will perform the services plus own stock. This is called personal service corporation. Second, if they perform services plus if they own stock more than 95%, okay, more than 95% of the corporation stock if they are owning, then they are called as a qualified PSC, qualified personal service corporation. So remember just the definition. Personal service corporation will be taxed at the flat 21%. What do you mean by personal service corporation? It's a corporation where the employees are the owners and who are going to perform the personal services, right? And the owner should own at least more than 10% of the FMV of the outstanding stock. This is the minimum I am saying. But if they are owning more than 95%, then that type of corporation will be defined as a qualified PSC. All right. Next is closely held company. We are all aware that what do you mean by closely held? If you are owning more than 50% of the value in that of the stock in that particular corporation by less than 5 individuals. Okay, so 5 individuals or 4 individuals are owning outstanding stocks in a corporation for more than 50%, then it's a closely held corporation. Got it? Next is affiliate group. So affiliate group means what? It's a chain of corporations. Chain of the corporation, the parent company. See, the parent company owns stock more than 80% of the total value, and there are different companies, right? They hold more than 80% of the stock of all the affiliate groups. So this is the first group, second group, third group, fourth group. So all the groups are held by a one parent corporation, and this parent corporation is holding more than 80% of total value. Okay, so this is affiliate group. There is nothing important in this, but just it's like you should know the definition. What do you mean by personal service corporation? What is closely held corporation, and what is affiliated group? Okay. Let's come to the important topic, that is property exchange for the stock. In partnership, we saw that to be a partner in a partnership firm, we should have, we should contribute first. So whatever the partner is going to contribute, accordingly, the basis will be decided. Same way, to be a member, right, in a corporation. Over here, right now, we are talking about corporation. So if a taxpayer is transferring any property, plus money. Along with the property, the taxpayer is also transferring some money, and against which he is going to receive the stock in the corporation, right? He is going to receive the stock in the corporation, the taxpayer, right? Here the member, I can say the stockholder, I can say transferring the property plus money in the corporation and receiving the stock. Then will this be taxable or not? It depends on the one condition, that is, if the taxpayer owns 80% of the class of voting share and more than 80% of the class of non-voting share. If these two conditions are fulfilled, then and only then this type of transaction is non-taxable. Got it? What if the person is owning like less than 80% of the shares? What happens? Then just check the second condition, whether he holds more than 50%. It is less than 80, but is it more than 50%? If yes, then whatever property, see this, whatever property is getting transferred to the corporation, at that time taxpayer might have incurred some loss, right? For example, FMV is less as compared to the basis, as compared to the cost basis, then in that case, whatever property is transferred to the corporation, this loss will be disallowed. We saw that it's in case of related party transactions, right? This loss will be disallowed. But if the corporation sells the property, same property the corporation is selling, then there might be a gain, and out of this gain, whatever was previously disallowed will be reduced. Okay, and whatever is the amount remaining after reduction of this loss will be taxable for corporation. Taxable for corporation as a capital gain. Got it? This second, whatever is the property, if he's taxpayer is holding less than 80% but more than 50%, then this transaction, this type of scenario will appear. Okay, let's move on to the next. See, if there is a control of corporation, then only the property transfer here will be non-taxable. Now what do you mean by control? Control means directly I can say 80%, right? 80% if the taxpayer is controlling, having the interest or having the stock in the corporation, then only it is non-taxable, right? If there is a control of corporation, then only the property transfer in the exchange of stock is non-taxable, else it will be taxable. So what if it is taxable? Gain the taxpayer will record. So what amount of gain the taxpayer should record? It's fair market value of asset received. Whatever he is receiving means what he is receiving. What he is receiving? Stock, right? So FMV of this stock we will reduce. What will reduce? Whatever we are giving up. So FMV of the asset giving up. Here see, cost basis is not taken at all into consideration. Take the FMV of the asset, take the FMV of the stock which we are receiving. I can say here the stock which we are receiving. Also, along with the stock, the taxpayer might have received some other property or asset. Then take FMV only. Here only FMV will be considered. Remember this thing. Don't get confused between the corporations and partnership. Okay. FMV of the asset received minus FMV of the asset given up. Right. this will be considered as a gain for the taxpayer if the control is not there. Means if the taxpayer is holding less than 80% of the outstanding stocks of the corporation. All right. Second is, what if instead of property, services are rendered? So if the stock is received in exchange of service rendered, then they are not subject to section 351 calculation. This is section 351 calculation. See, if you can see here, it's a 351 exchange calculation. So remember, in partnership we did three things: cash is contributed, services are contributed, and property are contributed. So the second thing, that is services, which they are like the partner is contributing here, that case will not be applicable. And if I'm contributing services against which I'm receiving stock, right, then it will not be considered as a non-taxable, and this 80% rule will not apply over here. Okay, so in that case, what I will do, whatever services I have rendered, I'll just take the FMV of the services rendered. Okay, if FMV is not available, what I'll do, basis of the stock received, that will be included in my income tax return as a income. Got it, everyone? So first was, whenever the property is transferred, we'll see that whether that particular taxpayer is holding 80% share, 80% stock, I can say, in the voting and non-voting. Remember these two words, voting and the non-voting share. If they are holding more than 80%, then only this transaction will be non-taxable, and this is a section 351 exchange. Okay, what if the taxpayer is not holding 80%? What the taxpayer will see whether I am holding 50% or not. If more than 50% or equal to 50% is held by me in the corporation, then the related party transaction will come into effect. If it's less than 50%, then you just have to make it taxable in your tax return as a gain. Just take the FMV of the asset received, right? Take the FMV of asset received means what? The stock. You're receiving the stock, right? Take the FMV of whatever stock you're receiving from the corporation and reduce the FMV of the asset given up. The property which you are giving up, just reduce that FMV. Okay. Second is, if the services are rendered, right? Stock received in exchange of services will not be subject to this provisions. Means I'll just take the FMV of services rendered and include it in my tax return as a income, as the ordinary income. Got it? Next is, if money or property received, right, instead of stock, now we are talking about money or property. Instead of stock, I am receiving money or property in exchange of other property. So what I'll do, see here, that stock is not at all included. Stock is not at all included. So what I'll do, directly calculate the capital gain. I'm giving up one property, I'm receiving the other property. This you will understand in detail manner when we do the basis of property chapter. Okay, the third chapter, I guess it is. Basis of property will complete that chapter. In that, you will be able to understand that calculation very well. If I am receiving a property in exchange of other property. Okay, so what I'll do, I'll just recognize the gain. How much gain I'll recognize if I'm receiving the money as well? So money plus FMV of other property. I'll directly take these two items. Money plus FMV of the other property will be my capital gain. Got it? The third scenario, see, I have included over here scenario wise part, like first scenario, second scenario, services are rendered. Third scenario, if money or property is received in exchange of other property, right? Along with the stock, I'm saying, see, I am receiving, sorry, I have not said this at earlier. See here, along with the stock, I'm also receiving property plus I'm also receiving money. So whatever is given up, I'll not take into consideration that. But whatever is the property and money I am receiving, I'll just take the FMV, right? FMV of the property and money, and I'll recognize that as a gain. We'll see the calculation over here, it will be more clear. Okay. Fourth thing is, what if the property which I'm transferring is having a liability, is attached with a mortgage? The corporation will have to assume that liability, right? The exchange will be treated as third number, see this one. It will be treated as whatever liability the corporation is assuming, we will treat it as we have received the money. See, just think it practically now. I was owning a one land, right? That land was carrying a mortgage. I have purchased it on loan, and till date I was paying the premiums and EMIs, and I can say installments for the mortgage loan which I have purchased to for purchasing the land. I have taken the mortgage loan. Till date I was paying that liability each month. Now what happens? Or today I am transferring that land to the corporation. So after today, will I be liable to pay any amount to the mortgage company? No, because the whole land is transferred to the corporation along with the mortgage. So I can say that my liability has been reduced. So that is a benefit for me. So I'll treat it as I have received the money. I'll treat it as a gain for me, right? And I'll recognize that gain. How we will do? There's a different calculation. We'll come to it in a bit. Okay. So whatever liability corporation has assumed during the exchange, we will treat it as money or property is received. Okay. If liability assumed by the corporation, now here we'll compare. If the corporation is assuming the liability which is more than the taxpayer's adjusted basis of property, see, it might happen that if it's a depreciated asset, like for example plant and machinery, so it is having a liability of say 1.2 lakh, right? And the basis in the property is just 1 lakh. Means liability is more as compared to the basis, adjusted basis. What do you mean by adjusted basis? Cost plus any improvements minus any expense, depreciation as an expense, I can say. So all this thing we will add and less, and then we'll receive at adjusted basis. We'll get adjusted basis. We'll compare this adjusted basis with whatever is the liability outstanding on that property. Okay, if the liability are more, see in this case liabilities are more, right? 20k it is more. So what we will do of this excess 20k? Excess we will recognize as a gain by the taxpayer. See, I am a taxpayer and I have to pay 1.2 lakh, but the adjusted basis of that property was just 1 lakh. So for me, 20k is the benefit, right? I don't need to pay 20,000 extra, which the company is anyhow, the corporation is anyhow going to pay, right? So I will recognize the gain. Okay. Then instead of property, let's say instead of property, if I am transferring the corporation trade accounts payable or interest, then no gain will be recognized by me. Only this will happen in case of property which is attached with a mortgage. Then only I'll compare that whether the mortgage amount, outstanding amount is more than the adjusted basis. If yes, then what I'll do? If yes, then I'll just record a gain. All right. So these are the 4 scenarios you have to just remember. First was very simple. 80% holding is not there, then we will just directly record the gain. Second, if the services are rendered, that will not be taken into consideration. So I'll just include the FMV of the services rendered in my box. Third is whatever money or property is received, right, in exchange of other property, then we'll recognize the gain. What will be the gain? Money plus FMV of the other property which we are receiving will be our gain. Fourth is liabilities if assumed along with the property transferred, then just compare the outstanding liability, right, with the adjusted basis. If yes, it is more, then only gain will be recognized. Okay. So this is important formula now for you guys to remember, and this will help you to solve any damn question from corporations chapter. Okay. So first what we'll do is, whatever stock we are receiving, just take the FMV. It will be given in the question, so don't worry. Take the FMV of the stock which we are receiving. If we are receiving cash along with that stock, just add it. FMV of stock received plus cash. Next, whatever is the liability assumed by the corporation, so that will be benefit for me, I'll just add it. Okay. FMV of the stock, cash received, liability assumed by the corporation, So here we'll get the total amount which we have received from the corporation. See, this is the simple formula. Whatever you are receiving, just take into account. Whatever you are giving up, just reduce it. Whatever you are receiving, take into account. FMV of the stock received. Cash received, then take the cash. If you have given up the property and the liability is assumed by the corporation, so that is a benefit for you. So you will just add that liability which was assumed by the corporation. Whatever is the total, right, out of this total, we'll just reduce the adjusted basis of the property transferred. You know now what is the adjusted basis, right? See, this is a summary revision lectures. You should at least know the basic terms, terminologies of each and every words which we are going to use in our sessions, right? Adjusted basis of the property transferred, we'll just reduce it. Then we'll come to amount. This we can call as realized amount. See, question will be twisted. They can either ask you that what is the realized amount, or either they will ask you that what out of this realized, how much should be recognized. Okay, so when you receive a amount, that is realized amount, when you come to an amount after this calculation, that is your realized amount. Out of this realized amount, you need to figure out how much should I recognize. The answer to that question is, I'll just recognize whatever is the cash received. We also call it as the bought received, right? Okay. Then this is the first step for the taxpayer's point of view, that how much is realized, how much is the recognized. Second thing we need to calculate is adjusted basis of stock. Now you have received a stock. What will be the basis of that stock? Okay, so again there's one more formula. Whatever is the adjusted basis of property which we are transferring, right? Adjusted basis of property transfer plus money. If you are also investing some money along with the property, we'll just add it and take. Plus any gain recognized. See above here, whatever is the realized, out of that we will recognize whatever was the cash received. We'll just recognize this one, right? So this thing we will add here, whatever gain we have recognized, minus whatever is the cash received from their side. Along with this stock, if they are providing me the cash, then I'll reduce it. I'll also reduce if I am receiving any other property, right? So FMV of that other property, I'll reduce it. Instead of gain, if there is a loss, see, while doing this calculation, it might happen that this figure is in negative figure. So whatever loss I have recognized, that also I'll reduce. This remaining figure will be considered as my basis, right? Adjusted basis of stock in the corporation. Got it? First thing we calculated, what will be the realized gain? Out of that, how much I am going to recognize. Second, we calculated that what is my adjusted basis in the corporation stock, right? Third thing, basis of stock received by the shareholder, right? Adjusted basis of property transfer, that we did over here. Then amount treated as a dividend or any gain recognized. If I am recognizing a gain, I'll just add it. Or if any other amount which as per the corporation is treated as a dividend, I'll just add it. Okay. Then I'll reduce whatever is the cash received or FMV of any other property received or any loss recognized. So this is the simplest version of this only. This both are same in fact. Okay. Next is basis of any other property received. At what amount should I record, me as a shareholder, record the property which I am receiving from the corporation, that will be FMV on the trade date. See, while reducing, we are considering here at the FMV, right? So in my books also, I'll record that property as at FMV only. Okay. Next is corporation's basis. So see, I am transferring a property to the corporation. So that property will be recorded in the books of corporation at what amount? Okay. So the adjusted basis for me, the shareholder, whatever I am transferring the property to the corporation, I'll take just the adjusted basis plus any gain which I have recognized in step 1. Do you remember here? Out of this, I have recognized this gain. We'll just add it. Adjusted basis of the shareholder plus gain the shareholder is going to recognize on this exchange. Okay, so this will be the basis of the property for the corporation, which the corporation is going to receive from the shareholder. Now, what if when the mortgage assumed and the cash received is more than the adjusted basis? So, difference amount will directly recognize as a gain. Simple. This was, see, this topic is actually very interesting and easy to remember, that at what time the gain will be recognized, how much it should be recognized. So just remember this formula. I'll say that this formula is most important formula. You can mark it over here. Just remember this, it will help you. Okay, let's look at some examples to understand it in a very well manner. For example, A and B, these are the two, I can say shareholders. They have contributed a property in one of the corporation against which they have received 100% stock. So is it more than 80%? Yes. So whatever property they have contributed, it will be considered as a non-taxable, right? It will be considered as a non-taxable. For example, if A has contributed 30,000 cash, along with that, he has also contributed, trailer, a machinery, I can say, for 15,000. So what is A's basis? Whatever is the cash he contributed plus whatever is the property he contributed, 45,000 will is basis in the corporation. If I talk about B, for example, B has contributed tractor who is having adjusted basis of 20K. 20,000, right? Adjusted basis. And against this, the corporation is giving him stock plus corporation also paying him a cash of 10,000. So what I will see, what is the B's basis? Basically, the B's basis will be whatever property is contributing, that is 20,000. Okay. Now against that, he is going to receive a cash. So that cash amount, that bought amount, I'll directly recognize as a gain. See, if I am receiving from the company, from the corporation, apart from stock, whatever I am receiving, and if that thing is cash, then that cash will be recognized as a gain. All right. Now, for corporation, at what amount should the corporation recognize the trailer which is receiving, which we are receiving from A? So it will be directly 15,000, whatever is the basis of the trailer. Plus, if there is any gain recognized by A is not going to recognize any gain, right? He is just contributing. He is not receiving anything apart from the stock. Anything received apart from the stock will be considered for recognizing gain. All right. So whatever is contributing 30,000 plus adjusted basis of the asset which is contributing, that will be the A's basis. A will not recognize any gain. So that's why for corporation, the amount of trailer will be just 15,000 only. Next, now let's see this second calculation for B. B is providing a tractor, right? Who is having a adjusted basis of, how much is the adjusted basis of the tractor? It's 20,000, right? So what corporation will do? Corporation will record it at 20,000. But then the corporation will see, wait, B has already recognized a gain of 10,000. So in this 20,000, we will have to include the 10,000 as well to record it in our books. So for corporation, 30,000 will be recorded as a tractor's basis. Simple formula, adjusted basis plus gain recognized. A has not recognized the gain, so that is simple 15,000. B has recognized the gain. Gain will be recognized if the shareholder is receiving anything apart from the stock. So anything apart from the stock is what? Cash. B is receiving cash. B will record 10,000 as a gain. So adjusted basis of the tractor 20,000 plus B, which the gain is recognized by B, that is 10,000. So that is how we come to a answer, that is 30,000 will be the basis which the corporation will record. All right. Next is the last scenario is amount of share received, okay, plus mortgage assumed plus cash received. We'll take all this thing into consideration. We'll reduce whatever is the adjusted basis transfer. See, this is simple. How much is realized? This I have done. I think we have done it at the 5th point. This is the same thing, but it's just written in the short manner. See over here. Amount of share received, right? FMV of the stock plus mortgage assumed by the company plus cash received, if any, will reduce the adjusted basis of the property which we are transferring to the corporation. All right. So this was about contribution to be done in the corporation. Next topic, the small topic. I'll just take this. Income tax return. If you are a corporation, remember in partnership. Remember like this: partnership and S corp are pass-through entities. Means the tax is not paid by the partnership or S corp. They pass that incomes, right, through K1 to the respective partners and shareholders, right? So for them, they need to provide K1 to the individuals before due date of filing 1040. Due date of filing 1040 is 15th of April. So before 1 month, that is 15th March, will be for partnership and S corp. Now, C corp. If I talk about C corporation, they are not a pass-through entity. They pay their tax by their own. They will calculate their own taxes and then they will pay it. So in that case, the due date is simple, the same as 1040 return, that is 15th of April. I can say 4th month from the end of the year. Okay, whatever is the year end, they can use any other year, right? Apart from the calendar year, they can use any other fiscal year, I can say. So it is 15th of April, 4th month from the end of the year. And if they want to extend it, they get extension of more 6 months by filing form 7004. Okay, and that is 15th of October it will come. Now, there is one more exception to this 4-month rule, which is if I am using a fiscal year, if the corporation is using a fiscal year which is ending on 30th of June, okay, only for those whose year is ending on 30th of June, remember this thing, the due date for them will not be 4 months from the end of the year, but it will be 3 months from the end of the year. Means from 30th June, you'll have to calculate 3 months, which is 15th of September. Here, 4 months is not taken into consideration. And if they don't file by 15th September, they can extend it. Yes, they can extend it, but not 6 months, they'll get extension of 7 months. Got it? Just remember this rule. Second one is the exception to the first rule. The due date is normally 4th of the end of the year, but if your fiscal year is ending on 30th June, it will be 3rd of the end of the year. And extension will be 7 months. If uses fiscal year ending other than 30th June, then the due date will be same, that is 4th from the end of the year, and extension will also be same, that is 6 month of extension they'll get. They will have to pay tax in full up to 15th of April. Okay. So how they will pay? They'll use estimated tax payment. If the expected tax liability is more than $500, then they'll have to pay estimated taxes. How the estimated tax will be paid? It will be paid at the end of each quarter till 15th, like 15th of April, 15th of June, September, and 15th of December, right? 4, 6, 9, 12, I can say the months. How much they will pay? 25% of annual payment. Whatever will be your liability, 25% will just take and pay it on the quarterly basis on each 15th of the next month of the end of the quarter, right? Next is, what if you you fail to file the tax return or you fail to pay the taxes? What will happen? Whatever is the unpaid taxes, right? The penalty will be from 5% to 25%. It can range any XYZ amount. Unpaid taxes, and they'll multiply it by the percentage. It can be 5%, minimum 5%, and maximum 25%. And if the failure continues for more than 60 days, right? if I'm not still, I have received the notice to file the return, like I have due date is there, for example, and I have not filed the return. And if that failure continues for more than 60 days, then what will happen? Whatever is the tax due or $435, whichever is lower, will be the penalty which I'll have to pay. Okay, failure to pay tax. This was failure to file. Failure to file. Now, what if I have filed the return but I have not paid the tax? Till what date I should pay the tax? It should be 15th of April, right? Or I can say fourth month from the end of the year. So 15th of April, I'll have to pay the taxes. What if I have not paid the taxes? Simple calculation is there. 1% of the tax due, whatever is the due amount of the tax, I'll take 1%, right? And I'll multiply it by 0.5. So that will be my penalty for not paying the tax. Okay. Minimum 25% of the tax due will be my minimum penalty, I can say. So this or this, whichever is higher, I can say. No penalty if while filing extension, I have at least paid 90% of the liability along with the extension filing. Along with the extension filing means 15th April, if I am already paid at least 90% of my total penalty, then there will be no 90% of my taxes if I have paid, then there will be no penalty. Okay. Next, what if I have paid more than that? Whatever is my liability, see, once I have extended, at that time I have paid a lump sum amount, and then I came to know that actually the tax liability is lesser than what I expected and paid, then you can apply for the refund by filing form 4466. Okay, 4466, you have to file the form to get a quick refund. Quick refund of the overpayment of the taxes. If your overpayment is 10% of expected tax liability, if it is more than 10%, and if it's more than 500, you can't apply refund for $10 or $20 or maybe $200. It will be automatically settled in the next tax returns. But if it's more than 500, then you can apply for refund. Before 16th, till what date you should file this form for refund? If before 16th day of the 4th month, means before 16th April. Okay, this is simple. 16th day, here it's 15th, right? 16th day of the 4th month plus before filing the return. Before filing the corporate tax return, you need to file this form, that if you have paid the excess amount, then you can take the refund. Required annual payment. Now, what is the annual payment which you should make? It should be 100% of the tax shown on the current tax year or 100% of the previous tax year, whichever is lower. So don't get confused. People normally take it as 90% of the previous. It is not like that. The rule is 100% of either current or 100% of either previous, whichever is lower. Rule is this: if you don't pay this, right, then you have to compare it with the 90%. This one, if you don't pay this, then you have to take into consideration the 90%. If at least 90% is paid, then you are saved from penalty. There is no penalty if it's more than 90%. Okay. C corp taxable income, if it is more than 1 million, right, then this thing is not applicable. Annual payment is not applicable. If the taxable income is more than 1 million, then this is not applicable, that whichever is lower, they'll have to pay. No, they'll have to pay the actual amount of tax liability which they are going to incur. All right. So next topic is special provision.